What we call the banking system has changed dramatically in the past 100 years. Our parents would probably visit their neighborhood bank and speak to a teller. In case you're wondering, a teller is an actual human being that works at a bank. Nowadays, we barely use ATMs anymore. Most of our banking is either done online or over our smartphones. As the technological and competitive landscape of banking has changed, so too has the structure of the banking industry. By structure, I mean two things. First, the business model of banks. This includes the types of products they sell. And second, the numbers, sizes, and physical locations of banks. In this session, we will focus on the historical trends in the US banking industry. We will see how changes in technology and regulation have given rise to what we call a bank in the 21st century. Our traditional bank does several things, but we can boil its business model down to taking dollars from depositors and giving them bank accounts, and then channeling those funds to borrowers, mostly in the form of loans. These bank accounts are basically money. We safely store our wealth without any price risk, and we have access to the payment system. For example, we can write checks or use debit cards. Banks also add value by ensuring only credit-worthy borrowers get loans. Traditional banks borrow, lend, and earn the spread between interest income on loans and interest paid on deposits. They are rewarded for their effort and risk-taking. Modern banking is complicated. Here is JP Morgan Chase's organization chart. It shows the business segments in which JP Morgan operates. This includes the consumer banking business for people like you and me, but also the wholesale banking business, which involves a lot more products. Organizations like JP Morgan have tens of thousands of subsidiaries that offer all types of financial services. How did we get from the traditional model of banking to a financial supermarket like JP Morgan Chase? In this session, we will discuss three organizational forms: the unit bank, the branch network, and the bank holding company. Two themes will run through our discussion. First, where banks are legally permitted to operate. And second, the types of financial products and services that these banks are allowed to sell. In the 21st century, it seems like banks are able to operate wherever they want and offer every imaginable financial service. However, it is important to recognize that this was not always the case. Throughout history, giving banks permission to expand or change what they do has been a source of vigorous policy debate. Let's start with how banks spread themselves out geographically. By this, I mean the number and locations of the brick and mortar office spaces of a bank. In the past, there were many restrictions on the number of branches that banks were allowed to have. States differed in their approaches. Some states were very strict. Illinois only permitted unit banking. This meant that a bank could only have one physical location. Here is the Continental Illinois Bank. It was located at 208 South LaSalle Street in the financial district of Chicago. All of the employees, including the CEO, were in one place. All of the loans were recorded at this building. Customers knew where to go. Unit banking was the law of the land in Illinois from 1870 until as late as 1985. I was shocked the first time I heard that. California was at the opposite end of the spectrum. They have always allowed banks to have branch networks within the boundaries of the state. Here is the branch network of Bank of America circa 1929. It used to be headquartered in San Francisco with branches throughout the state. There are several reasons why Illinois and other states enacted strict branching rules. Opponents of bank branching argued that banks could grow too large and exert monopoly power. Bankers, especially those in small towns, were strong supporters of branch restrictions. They believe it protected them from competition from larger, out-of-town banks. Other states believe that larger, more geographically diversified banks would be more resilient and safer. While there was much disagreement about whether unit banking or branch networks were safer, banking panics were common in this era. Here are two famous quotes about this time. The first points out how frequent banking panics were back then, and the second points out how they eventually became global in scope. Panics work like this. Typically, some depositors began to worry about losing their savings. Why did this happen? Well, these depositors began to worry that the economy might be taking a turn for the worse, and their bank might incur large losses on their loans and eventually fail. Remember that this was before we had deposit insurance. This means that only those depositors who failed to withdraw their money in time would lose out. Hence the run on the bank. These banking panics peaked during the Great Depression of the 1930s. This was probably the worst global financial crisis in modern history. More than 1/3 of all banks failed in the United States. Millions of families lost their life savings, and the economy crashed. As an emergency response to the banking crisis and ensuing depression, President Franklin Roosevelt enacted the Banking Act of 1933. This famous piece of legislation is also known as the Glass-Steagall Act. What changes were put in place? There was a ban on interstate bank branching. This was a geographical restriction on banking. Banks were not permitted to have subsidiaries across state borders. There was a ban on investment banking. Commercial banks were banned from having underwriting or from dealing in private securities or even writing insurance. The law included Regulation Q, which banned interest on deposit accounts. Finally, the Act created the Federal Deposit Insurance Corporation. The FDIC provided insurance to individual depositors. If their bank failed, they would not lose their savings. These bans reflected beliefs about the causes of bank panics. Interstate branching caused panics to spread like wildfire. Investment banking was too risky. The payment of interest on deposits led to excessive competition among banks. Bank runs were caused by confused investors worried about losing their savings. The Glass-Steagall Act created a highly regulated and protected commercial banking industry. This graph shows the number of insured commercial banks between 1935 and 1956. It shows unit banks and banks with multiple branches. During this period, there were a large and stable number of banks. These were mostly unit banks with local monopolies. This was a system of government-insured banks with simple product offerings and limited risk-taking opportunities. The Glass-Steagall Act restored confidence in the banking system. This chart shows bank failures plummeted from a peak of around 4,000 in 1933 to effectively zero. However, at that time, many critics viewed the heavily regulated US banking system as far too fragmented and inefficient.